makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacqua. Here's what's coming up on today's program. Telecom Italia shares erasing their gains over uncertainty about the company's blockbuster deal to sell its landline network to KKR. In the meantime, Ryanair shares gaining after the budget airline announces its first ever dividend, but the company still cautious on higher fuel bills. More of our interview with the Ryanair CFO. Plus, in geopolitics, the U.S. Secretary of State Antony Blinken arriving in Turkey as part of its latest regional tour to try and prevent a spread of the Israel-Hamas war. A lot of cross currents here. Let's dive right into the market reaction. Take a quick check at the European markets map, because when you look across Europe, you'll see a little bit of green on the screen. Now, this is positive. A lot of that gain is going to be coming from two main factors. One is going to be the Telecom Italia story, and some of it is going to be the dovish pivot as well. But it's also going to be perhaps some of the data that we are getting right now. Euro area October services PMI coming in at about 47.8. The prelim was, get this, 47.8, so bang on expectations. But you've actually compared this to what you saw in just the last 5-10 minutes or so out of Germany and France. A quick review there. The October services data out of Germany was the PMI of 48.2, slightly stronger than the estimate of 48. Then for France, 45.2, coming in weaker than the prelim of 46.1. So again, a mixed picture in Europe. Surprise, surprise. But right now, overall, euro area coming bang in line. Not much reaction out of the euro, but again, a lot of that is going to be a function of what you are seeing from the dollar, which again is a function of what you're seeing from the Fed pivot, or at least what the market's interpreted as a Fed pivot, which brings me to the big data point, I think, of the last week, which is really leading, I think, the market reaction on the macro front. Is going to be that U.S. jobs data. That's the chart I'm showing you right now on the air. 150 new jobs when it comes to non-farm payrolls. The estimate was somewhere between 180 to 200. What's important to keep in mind here is that this is one of the very few times that the jobs number has actually come in significantly below the estimate, and that is both positive in terms of introducing slack into the labor market, but a negative if you interpret it as simply that the resilience of the economy, the American economy, is cracking. That's an early sign. So what do the markets do? Well, I think the best way to look at that is through the Fed swaps pricing. Simply this idea here that you are seeing that a dovish pivot is what the markets are expecting, that in June 2024, you are going to get a full cut from the Federal Reserve. Now, we have seen this movie before. It has happened before. But I think the fact that Chairman Powell didn't double down on his hawkish rhetoric that he usually does in the meeting last Wednesday has really changed the pricing quite a bit. The NFP report has only added to that. And remember, 150,000 jobs was really something that's supposed to be normal pre-COVID. Post-COVID, perhaps a return to normalcy and therefore a return to those recession calls. And that's just some of our top stories on the macro front that we're watching. Let's get to the micro here and talk about Telecom Italia. Shares slipping, erasing their earlier gains. Were higher by almost 5.5%. Now you're seeing the shares down 3.5%. This comes after the company approved the sale of its domestic landline network to U.S. private equity giant KKR for 22 billion euros. The deal is expected to close by next summer. Now, joining us for more on this is Bloomberg's Rome Bureau Chief Chiara Albanese. Chiara, a pleasure to have you on the program. Thank you so much for joining us. Let's start with just how big of a deal this is. Where does the Italian government stand on it?
Look, this is a big deal, and the Italian government has been backing the progress on the sale, also because it will own a stake and the end of the whole process. But as we are seeing in the share reaction this morning, at the announcement that came late last night does not mean that the game is over here. The shareholders are threatening a legal battle, and that is very unclear on how that could be effective and which measures that could be used.
You went right where I wanted you to. The Vivendi opposition here. I mean, we know it's their biggest shareholder. We also know this vote wasn't even run by the shareholders at all. How big of a deal, how big of a fight could they put up? What does that actually look like?
So while at the end of the day, it doesn't seem like they've got enough votes to actually halt the sale, the noise and continuous threats that they could present to Telecom Italia and also to the government in order to stop the process could be very demotivating for the whole process, and also erode part of the financial gains that are part of this deal. We should always keep in mind that the value of the whole process process is also dependent on how many synergies and earnouts can be squeezed out of the merger with Open Fiber, creating a single network. And it is very unclear how that could happen with the legal battle playing behind the whole scene.
Well, there's a lot of different pieces to this Telecom Italia network and grid, as you point out very specifically. I think there was a lot of hesitation about the cable network that you just brought up as well. What's actually next for the business itself? In 12 months' time, what does it look like?
Well, taking a network away from a telecom company is quite a hybrid, and it is very unclear how Telecom Italia could survive on its own feet without controlling the network directly. So we should expect more players involved in this big saga over the next months, potentially with mergers, acquisitions, and also companies looking at Italy from abroad.
It's a really interesting dynamic at a time that's expected to perhaps even flush the Italian government with a little bit more cash. We'll see how this actually plays out. Bloomberg's Chiara Albanese in Rome, we thank you so much for joining us this morning. It's just one of the stories that we are watching. The other brings us right back to the macro front. When we get to U.S. jobs report, which some investors bring forward the bets that the Fed may be done raising their rates. Atlanta Fed President Raphael Bostic weighed in on what that might look like.
Today, my outlook is that we're going to stay on that slow and steady. And if we continue to do that, then I think where we are now will be sufficiently restrictive to get us to the 2% level for inflation. But there's still a lot that's going to happen between now and even the next meeting.
Joining us now for more on the Fed and the broader market story, Freya Beamish, Chief Economist and Head of Macro Research over at TS Lombard. Freya, a pleasure to see you again. Look, the theme, I think, of what Chairman Powell, what Raphael Bostic, and even what has resulted in a deal in Italy is that there are deficits and there are budget concerns around the world. That seems to be the one thing we can all agree on. When it comes to the Federal Reserve, though, the tide has changed very, very quickly, from very hawkish to what the markets are interpreting as a very quick, dovish pivot. Is the market getting ahead of itself?
I think we are still in that stage of the game where we're in the immaculate disinflation part of the story. I think moving towards 2024, disinflation might start to become a little bit more maculate in the sense of a little bit more painful. As in, it might require for disinflation to continue in 2024. It might require the economy really to be running below trend. And the main consideration here, I think, there's a lot of uncertainty, but the main consideration, I think, is the extent to which the U.S. is still in what I would term as monetary disequilibria, as in it's a fancy way of saying that there's too much money still compared with what people can buy in the real economy. In the rest of the world, I think we're pretty much back to what I would think of as an equilibrium kind of rate of turnover of money in the economy. And that means we're much closer to that kind of immaculate disinflation where inflation is coming down because the economy is weak. In the US, we're still just at that kind of tail end of COVID distortions coming out of inflation, and the economy remaining still reasonably resilient because of that kind of excess of money that's in the economy still in the US case. But I think we're kind of working through that reasonably quickly now, and we should hit that kind of critical point around the kind of the middle of next year. And looking to the jobs data, I think what happens between now and then is that you just get this continual grind slower, resilience, but grind slower that comes through in the jobs data. When that September number came out, we were saying, no, it's done. It's printed above its downtrend 5 times over the course of the downtrend that started in 2021. So the likelihood is that it prints below the downtrend again, and that is what came through in the October data. So we continue to see that kind of grind slower in the economy, in the jobs data as well.
I mean, at the core of what you're saying, though, is that with all this kind of excess money in the system, what you're seeing is basically asset price inflation in the financial markets. And I kind of want to zoom in on the bond market story very specifically, because one of the things that Chairman Powell and some of his colleagues around the country had said, and I think you've heard this from both the BOE and the BOJ, I imagine Christine Lagarde would agree, is that the bond sell-off, I should say, on the long end of the curve that we saw before the Israel and Hamas conflict actually broke out had a pretty substantial impact on how hawkish the Federal Reserve might actually be. The fact that the markets might be doing some of the work for it. But Freya, let me ask you, if it goes in the opposite direction, if you see this bid for bonds sustainably stick, can the market do the job of a rate cut for the Federal Reserve?
I love that question. It's so kind of chicken and egg a little bit when you get to this stage in the cycle. But I think, cut a long story short, I think we will see that kind of slowdown. I'm not really looking for a kind of a typical recessionary dynamic in the US case. It's more of a kind of an economic reset. So yes, the fact that real yields have risen so far over the course of this year is part of why we're seeing why we're forecasting a continued slowdown. And I think that is not yet in the real economy data, and that's what we'll start to see coming through into next year. If yields are coming down now, to me, that's a sign that the economy is starting to roll over. There's a lot. It's complicated because we have to bring the liquidity side of it in as well. I think part of the reason why yields are softening a little bit is because that kind of TGA, the Treasury General Account rebuild that happened after the debt ceiling was raised, that's slowing down a little bit now as well. So the liquidity situation is getting a little bit easier, not easy, but easier. And at the same time, I think the economy will be slowing. You can look at it from that kind of monetary disequilibrium way that I thought about it or talked about it. But you can also look at it just in the sense of how long it would take for that monetary tightening to feed through, including the impact of the real yields that you've just talked about. And looking to next year, there is a maturity wall in corporate debt. There is the likelihood that people will or already seem to be saying, okay, well, I can't just remortgage now and then remortgage next year when rates will be lower. Therefore, I better put off my remortgage, and that's impacting on the housing market. So we had this kind of bounce in housing after the initial shock of the rise in rates, and now that seems to be rolling over as well if you look at the survey data. So it's just this slow kind of grind towards what I would call an economic reset, but not an outright recession. And that's important because the private sector looks a lot cleaner than it has in previous kind of pre-recessionary stages, and that's where your secular bear bond market comes into the story.
Well, you're talking about this slow, almost painful grind. So let me lean into that and talk about the 60,000-foot view, because you just mentioned the Treasury account specifically. Are you at all concerned about this higher for longer narrative, not from the Federal Reserve, but more as a function of global demand for treasuries kind of being eliminated? China, Japan, even Saudi Arabia, all cutting their exposure to the treasury market at a time when we're talking about a fiscal deficit in the United States. What does the Federal Reserve do when liquidity isn't on their side?
Yeah, so coming towards the kind of the secular term, that is one of the major drivers that we've been forecasting, that China is going to be in a situation where they're kind of pushing against the depreciation of the currency. They've sort of passed their Minsky moment. There's a secular drift towards a real effective depreciation of the renminbi, and that pulls China out of the U.S. Treasuries market. The same for Japan, which has been another big inflow and another big kind of anchor to real yields over the secular term. The Bank of Japan very eager to move away from the distortionary aspects of the long-term accommodation in which it's engaged, and also even kind of signs of secular increase timidly in inflation even in the Japanese case, as part of that global kind of shift as we are forecasting towards higher inflation on the secular term. So you've got a lot there in terms of the flows. You've also got a lot in terms of the likelihood of higher real yields and in terms of higher inflation in developed markets themselves, as we retreat from hyperglobalization, as we move on from deleveraging, as there's greater likelihood of cost push shocks coming through from destabilized geopolitical world and the climate shocks as well. So there's a lot that's all pushing in the same direction with regards to the secular drift in yields. And if there is an economic reset, this might be like your last chance to get a tactical long in bonds before the kind of the second leg of that secular bond bear market comes through.
Some economic analysis, some bond analysis. What can Freya Beamish not do? Chief Economist and Head of Macro Research at TS Lombard, we thank you so much for your insights this morning. Coming up on the program, U.S. Secretary of State Antony Blinken arriving in Turkey in his diplomatic push to contain the the Israel-Hamas war. We get more on the latest on the ground coming up next. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now, the U.S. Secretary of State Antony Blinken's diplomatic push continues to try and contain the Israel-Hamas war. He has now landed in Turkey after making an unscheduled stop in Baghdad, as well as meeting Mahmoud Abbas in the West Bank. Let's get more from Bloomberg's Onur Ant in Istanbul. Onur, pleasure to have you on the program. Bring us the latest on the ground.
Israeli military struck over 450 Hamas targets over the past 24 hours, while its ground forces encircled Gaza City from the north and south. From now on, we expect more close-quarter urban warfare in Gaza Strip between Hamas and Israeli Defense Forces. This is the north of the Gaza Strip, the besieged territory where more than 2 million people currently live. In the south, there's another important development, the Rafah border crossing between Gaza Strip and Egypt, which saw flow of some foreign nationals or people with dual nationalities, as well as wounded Palestinians into Egypt since the 1st of November, have seen a blockage of activities since Saturday, when Hamas accused Israeli Defense Forces of violating the terms of an arrangement that allowed people to cross from Gaza into Egypt since last week. And as far as we know, this is the third day that there has been no crossings through Rafah. It's important because this arrangement was arguably the only diplomatic achievement, so to speak, since the fighting began early in November.
Yeah, big question about how much these diplomatic efforts are actually working. Bloomberg's Onur Ant in Istanbul, we thank you so much for your reporting this morning. Much more to come after the break. Stick with us. This is Bloomberg.
We're now comfortable that we can also sustain an annual ordinary dividend. To put this in context, the first ordinary dividend of 400 million equates to what our shareholders invested in the height of COVID. And so we're delighted this morning now to be able to effectively refund that. They put 400 million into Ryanair in September 2020. We then raised a bond on the back of that and come out of COVID with a very strong balance sheet. But going forward, the board have committed to 25% payout of prior year profit after tax starting from the next financial year. So 35 cents, which will be paid between February and September of next year. So I think it's a strong vote of confidence in the business that we have the balance sheet strength to be able to sustain large capex program, invest in growth for our shareholders, but also to return some funds to them as well.
Well, you mentioned a good chunk of that is coming from your bond issuance as well. Neil, I want to go there next, because if you actually look at your debt distribution, you have about $2.8 billion in debt coming in due by about 2027. At the same time, you have this massive payout promise. A lot of people would look at your numbers and say, well, this is great right now, but what happens when you start to see the macroeconomic risk really weigh on European consumer demand? A lot of questions about how quickly recession is going to hit in Europe, and by extension, how that's going to hit your bottom line. How are you going to service the $2.8 billion of debt you have coming due?
Yeah, well, we finished the half year with 3.6 billion in cash, and that was after paying down $1 billion in debt in August alone this year. We had a 750 million maturing bond, and we paid down 260 million of our revolving credit facility. We've effectively paid down half of our debt in the past 2 years. We've got a very manageable profile with the next bond maturity in 2025 and then the final bond maturing in 2026. So similar to what we've done over the past 2 years, we expect to be able to service the capex out of our own cash resources, but also the bonds as well, which puts us in a very unique position compared to our competitors who are raising funds in rising interest rate environments, paying significantly higher lease costs for their aircraft. We're actually paying down debt out of our own cash resources, which hugely widens the cost advantage that we have over everybody else. And then just touching on your demand question, demand is very strong. As you saw, we had 105 million passengers in the first half of this year. We're targeting 183.5 million on a full year basis. We've 90% of our summer 2024 schedules on sale already, and bookings are strong because capacity is very constrained in the market at this point in time and likely to remain constrained. We're only at about 94% of pre-COVID capacity, and I think capacity will remain low for some time to come.
The Ryanair CFO Neil Sorahan there speaking about their first ever issuance of a dividend, how they're going to service that $2.8 billion of debt, something that the markets are actually loving. Shares higher by about 6.2% off of that unprecedented announcement. Coming up on the show, Warren Buffett and a record pile of cash. We're going to dive into it. Stick with us. This is Bloomberg. Telecom Italia shares are racing their gains over uncertainty about the company's blockbuster deal to sell its landline network to KKR. Meanwhile, Ryanair shares gaining after the budget airline announces its first ever dividend. The company cautious on higher fuel bills. More in our interview with the Ryanair CFO. Plus, in the Middle East, the U.S. Secretary of State Antony Blinken arrives in Turkey as part of his latest regional tour to try and prevent a spread of the Israel-Hamas war. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. One of our top stories here, Warren Buffett's Berkshire Hathaway has reported for the third quarter the company feeling the effects of a deals drought with cash pile hitting a fresh record. Let's discuss the results. Bloomberg's Charlie Wells joins me right here on set. Charlie, let's talk a little bit about these operating margins because everyone else seems to be shrinking. And somehow Warren Buffett coming out a pretty big win.
I mean, the story here really is about insurance. So, Berkshire Hathaway is such a huge holding company in the U.S. They hold companies ranging from insurers to railways to Dairy Queen, the fast food retailer. But basically what we saw is these huge holdings that they have in insurance, at least in this past quarter, performed very well relative to the same period last year. So 2022, really tough for the insurance market. There were a lot of sort of outsized events that really hit the bottom line. But this quarter, the insurance unit at Berkshire Hathaway posted $2.42 billion in operating earnings, which was a huge boost.
Well, with higher margins comes more cash. And ordinarily, we all love to have a little extra cash in our pockets. You can see in the chart right there, we're talking about a record amount of cash for Berkshire Hathaway. But in an inflationary environment, that costs you. Cash is worth less in an inflationary environment. Do you think they're going to feel some pressure to deploy it?
I mean, that's the concern. So investors so far have really been liking Berkshire Hathaway's stock. So it hit a record in September. It's up 14% year to date. Berkshire Hathaway actually spent $1.1 billion in the third quarter buying back some of those shares. So that's going to make people happy, at least in the short term. But as you say, cash earns less in an inflationary environment. And Berkshire Hathaway is known for making these value investments. And at some point, investors could start asking, what are you going to do with that money? Where is the value in this environment right now?
And what we love about Berkshire Hathaway, specifically Warren Buffett, besides the fact that he lives on a farm in Omaha, is that he is his investment playbook is the kind of picture of the American economy. We're talking about railroads. You talked about Dairy Queen. What's more American than that? But as well as oil companies, Coca-Cola, even Apple. What do his investments and Berkshire Hathaway's investments, by extension, say about the American economy?
It's a really good proxy, and it's interesting, I think, thinking about high interest rates, because what Berkshire's results really seem to tell us was that, higher interest rates are actually impacting some segments of this holding company. So when you look at home builders that are negatively affected by higher mortgage rates, that's one area of stress that we saw. But look, this higher rate environment for Berkshire, as well as for the U.S. economy, is causing some stress, but it's not really kind of blowing the whole thing away, as a lot of people feared. And even back in May, Buffett warned at the AGM that there could be some hits to revenue this year, and that hasn't actually panned out quite as negatively as he may have thought back then.
Yeah, we'll see if he does actually end up deploying some of that cash that he's raking in from the insurance business, apparently, to perhaps not the benefit of the people who are being insured. Bloomberg's Charlie Wells, we thank you so much for that. Now, before we move on to some more earnings, I want to bring you some economic data. The UK October construction PMI rising to about 45.6. That is relative to 45. You get a quick check on the pound here, the cable rate. That is where you're going to see, well, a little bit of movement. 1.24 is where we're at on the cable rate. And look, what's important to keep in mind here is that a lot of that acceleration that you saw before the data actually hit came from dollar weakness. You're seeing a similar move in the euro as well. Again, a function of the macro story, but that latest leg lower or pairing of that gain is actually coming from the data. Again, 45.6, the estimate, or I should say the prior reading was about 45. So a slight acceleration, but again, not enough, I think, to create sustainable strength in the FX market. So that is your economic data. Quick check there. Let's get a move on to the earnings story in Europe. Plenty of companies have been earning. We're going from telecoms to energy to some even the consumer sectors, even talking a lot about the banks. UBS, Commerzbank, ABN AMRO, all reporting this week, and that's what we have our eye on next. Let's bring in Bloomberg's Maggie Schiltag. Maggie, let's start with UBS specifically. A lot going on, a lot of spotlight on them after the Credit Suisse transaction. What are we paying attention to?
Yeah, so obviously a highly anticipated set of results from them tomorrow, given it's going to be the first full quarter, including Credit Suisse. Now, UBS will be very eager to start showcasing some of the benefits it's seeing from that takeover. And I think investors will really be looking to get a bit more of a gauge as to where that future value is really going to come from the takeover, as well as honing in a bit more on that key talent acquisition across the company. Attention will also continue to be on the bank's wealth flow and deposits, as well as its pipeline going forward. It's very much more skewed towards equities trading than many of its peers, particularly in the US, and that potentially bodes well for the bank tomorrow, as we've seen very strong sets of results, particularly from US banks, Morgan Stanley and Goldman Sachs, who all beat on that front. So that really bodes well for UBS tomorrow.
What's really interesting about UBS is that they kind of, to your point, have that fixture in equity trading as well. Some of the other European banks still trying to kind of make their way. Talk to us about what we can expect from some of these other European banks at a time when we're expecting interest rates to peak.
Yeah, exactly. So far this season, we've really seen a clear outperformance from the US, given that their economy is continuing to grow pretty strongly. And I think going forward, we could continue to see a bit more of that transatlantic divergence as we continue to see a bit of a slowdown in Europe, which could impact banking products going forward. So it'll be interesting to see what kind of effect that will have on demand. And as you said, as we continue to hear more and more about interest rates potentially having neared their peak or peaking, it will be interesting to see how banks deal with that going forward, given that they might be forced to find some new avenues for growth as we go on.
And that's going to be crucial from the banking sector, but then we're also getting results on the telecom side as well. No shortage of earnings this week. Telefonica, Deutsche Telekom. What's on your radar there?
Exactly. So the focus for both of those reports will be shareholder returns as well as cash flow going forward. Now, Deutsche Telekom set the scene very nicely for themselves last week when they announced that they plan to increase their dividend for the year by 10%, as well as buying back 2 billion euros worth of shares. Now, analysts after that were saying that could just be the start for them. So it'll be interesting to see how much further they can take that. Now, Telefonica, recently described as Spain's most strategic company, its results are going to coincide with a capital markets day. So the focus for that update will really be looking more into their midterm strategy as well as their outlook for their ongoing cash flow. Now, given all the news recently, particularly yesterday's from Italy, all eyes now for Telefonica on the Spanish government's next move after last week. Yeah. They said that they are thinking about taking a stake in the company to warn off any foreign competition. So it'd be interesting, given what else has been happening, to see where they take that.
Yeah, it feels like Italy almost setting the precedent for the rest of the continent. Certainly something we're going to be watching very, very closely. Bloomberg's Maggie Schiltag, we thank you so much for your analysis this morning. And, of course, she was talking about the bank story. We're going to bring you our interview with the UBS CEO, Sergio Ermotti, tomorrow at 7 a.m. London time, right here on Bloomberg. We're also getting some headlines, by the way, from another major company that everyone, I think, knows is Tesla, rising by a pretty substantial margin, almost 3% on the day. This coming after a Reuters report that they're going to build 25,000 euro cars at their German plant. This is pretty significant when it comes to the actual pricing here, because about 25,000 euros is substantially lower than what a Tesla car actually goes for. The fact that they're increasing that at their German plant is also pretty telling. But again, affordability is going to be a key issue in terms of appealing to the European consumer, where, of course, fewer here have appetite to even buy cars. So nevertheless, Tesla shares higher by 2.6% on that report. And coming up, I guess we're going to stick with Elon Musk here, renewing his calls for regulating artificial intelligence. We take a closer look at the challenges in the tech landscape. Tom Smith from Geradin Partners, also the former legal director of the CMA, is going to break it down for us next. Stick with us. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now, Elon Musk has revealed his own artificial intelligence bot to challenge ChatGPT. The billionaire says the Grok platform will pull real-time information from messages posted to X and has a, quote, rebellious streak and loves sarcasm. Now, a limited group of U.S. users are testing the prototype, which has been in development for 2 months. In addition, last week, Musk renewed calls for AI regulation in a televised chat with UK Prime Minister Rishi Sunak at the two-day AI Safety Summit. A lot coming out from Elon Musk here, but I think the broader topic we need to know, with all this new technology, how do you regulate it, especially right here in the UK? For that, I want to bring in Tom Smith from Geradin Partners, who also has formerly served as legal director at the UK's Competition and Markets Authority. He has had his hands full for the past, I want to say, decade or so. It's been a lot. Tom, let's dive in here, because we started talking about Elon Musk and his many ventures, but I want to broaden that out to big tech largely. We're just coming off in the last couple of weeks, really, of approval that the CMA had very notably pushed back against Microsoft's really historic acquisition of Activision, $69 billion on the table. It doesn't really sound like they're planning on stopping there. In your expertise, how big is the CMA going on big tech?
Yeah, it's a very different environment to what it was 10, 15 years ago. I think the CMA and, in fact, lots of competition authorities all around the world think they've been too laissez-faire. They've allowed too many deals to happen. They point at old deals like Google DoubleClick or Facebook Instagram as deals they should have blocked. So they're definitely blocking more deals than they used to. Microsoft Activision obviously got through in the end with more concessions in the UK than there were in the EU. But it's not that simple a picture that the CMA is being the aggressive ones, because recently the European Commission blocked a deal from Booking.com, the e-Travelly, which is a relatively small deal that the CMA had cleared, but then Brussels intervened in. Yeah. So it's a complicated picture.
Well, talk to us then about some of the specific American companies here. Recently, we know Meta and Amazon as well had to make some concessions with the CMA. Can you walk us through what those actually looked like and whether or not you think it really makes that much of a difference?
Yeah, I mean, there's a lot going on in competition law. So just on Friday, 2 big cases were settled by the CMA. Meta agreed some limitations on how it would use its advertisers' data. And Amazon also agreed some commitments to the CMA about how it would run its marketplace. It's all against the backdrop of the Digital Markets Competition and Consumers Bill that's going through Parliament that will give the CMA really extremely wide powers to regulate the big tech firms once it's designated them as having strategic market status under the Act.
Do you see that as eating into a lot of the way they currently operate right now? I feel like from an outsider's point of view, when you hear regulatory action, nobody exactly embraces that, right? But when you look at it from a big tech point of view, the way that Meta, Amazon, et cetera, operate in Europe relative to the rest of the world is still significantly small. Do you see this bill as having a material effect into how it operates not just in Europe, but around the world.
Yeah, I think it will, but it's not just the UK. Most of the developed economies are doing the same thing. Australia's got a similar proposal. The EU Digital Markets Act is already on the books. And then there are the big legal cases in the US by the FTC against Amazon and the DOJ against Google. Then you have the South Korean App Stores legislation that's already on the books. So it's really everywhere. So I think if the UK was doing it on its own, you'd think, well, are they really going to be able to move the needle worldwide? But they're all moving forward together.
Well, you mentioned South Korea specifically because we also know that they came down on some of the cloud services as well that some of the big tech had offered. Now we know that Ofcom has officially passed on the investigation here in the UK to the CMA as well. Now, we have some time before we get any sort of real result on that investigation, but what is the CMA worried about when it comes to cloud, which I feel like it's been in the marketplace for, again, at least a decade?
Yeah, it has. So the things they're looking at is so Amazon with AWS and Microsoft with Azure are the two biggest players by a long way. Google is very much smaller, like 5 to 10% market share kind of thing in the UK. And the CMA is going to be looking at whether customers are locked in, whether they are actually able to switch their custom elsewhere if they wanted to, whether they can multi-home. So they're going to be looking at pretty kind of middle-of-the-road kind of competition remedies, helping customers to switch, making sure they're not locked in, making sure the discount structure doesn't make customers unwilling and unable to multi-home, things like that. How
much has the CMA's now success with Microsoft emboldened them to take on some of these other companies? By comparison, if you look at what's going on in the United States, the FTC's Lina Khan has attempted that and has tried multiple times and failed multiple times. To what extent is the CMA setting global precedent here?
Well, it is a little bit. I think you could argue whether the CMA will be emboldened or, in fact, made more timid after Microsoft Activision with all the fallout from there. Talking about Lina Khan in the US, the big thing there is the FTC's lawsuit against Amazon, which really is going at the heart of Amazon's business model. That's in fact probably a bigger deal than any single merger.
At its core, though, I mean, this is, I think, in the bylines, I imagine, of the CMA. It's helping customers, and they're currently looking at this deal from Vodafone and Three. A concern that any kind of lack of competition, as is put in the title, is going to end up in very high consumer prices. We know that the UK has, in the past, blocked other mergers from Three as well. What do we think about this deal? Do you think it'll go through?
Yeah, the climate change, so 4 to 3 telco mergers have always been a big thing all over Europe and in the UK. And as you rightly said, the 3 and O2 merger was blocked in 2016. So the climate's changed a little bit in that the telco companies have a much better argument about the need to invest in 5G, 6G and then on.
Yeah.
So they're trying to, that's their case, they're trying to show that they actually need to merge in order to get the scale to invest.
Yeah.
But, I mean, the CMA will be relatively sceptical about that. The CMA will be worried, exactly as you say, about consumer price rises. You've got the trade union opposing the deal, saying that it'll add £300 to consumers' bills.
Yeah.
So they'll be running the really very detailed econometric analysis, statistical analysis to see whether the parties do indeed have a post-merger incentive to raise prices. And so it'll all be down in the details for the next year.
What might a remedy on that front actually look like? How do you, in the face of a real lack of capacity that, as you point out, for the telecoms, how do you actually prevent prices from rising?
So there are parliamentary committee hearings last week or the week before where the companies are promising not to raise prices, but that's not really going to cut it. You need to prove that they don't have the incentive to raise prices post-merger, because if they have the incentive, then they'll probably do it, whatever they said to a parliamentary committee.
Yeah.
But yeah, so it's going to be a big fight for the next year.
A lot to digest, a lot on the CMA's docket. Geradin Partners, Tom Smith, we thank you so much for breaking it all down for us. Coming up, we unpick the struggles of Europe's biggest economy. It's at a political crossroads. Stick with us. We're going to dive into it next. This is Bloomberg.
We needed a little bit more coal. We let the coal power plants a little bit more longer in the system. But now the security issue is more or less solved. We were able to build up LNG terminals with incredible speed. We have now 3 operational and 3 more coming over the winter. And then we would have enough gas to go back to plan A. And therefore,
so you can phase out coal by 2030?
Yes, absolutely.
German Vice Chancellor and Economy Minister Robert Habeck there, speaking exclusively to Bloomberg's Anna Edwards. I want to stick with the conversation around Europe's biggest economy and dive into today's Bloomberg's Big Take. It is on the rise of Germany's far-right AfD party, targeting frustrated voters amid a persistent economic slump and a surge in immigration. Joining me now to unpack all of this is the authors of today's Big Take story. Chris Ryder joins me from Berlin. Chris, good morning. Walk us through what the German political landscape looks like right now.
Yeah, well, it's extremely fragmented. I mean, as you mentioned, the rise of the AfD is one part of the equation. The other part is the decline in mainstream parties like Olaf Scholz's Social Democrats. And that fragmentation comes out of the series of crises that Germany is facing. You mentioned the energy crisis is one. Habeck talked about that as well. And efforts to stem sort of that crisis has also reached kind of over, like for some voters, is seen as overreached. There's a heating reform this spring that was incredibly controversial. And in general, there's massive changes going on. There's the economic malaise happening. It just comes on the heels of COVID. So German voters are feel very stressed and and there's more and more people feeling left behind. And that's making it more difficult for the mainstream parties to come up with a response.
Where does Olaf Scholz fit into all of this? I mean, his economic, his fiscal policies, are they good enough here when it comes to holding off this AfD offensive?
The difficult thing, I mean, Scholz, for many voters, he has very low approval ratings. He's seen as kind of disconnected from the average German, from the problems that people face. He's not necessarily super present in the public eye, and he's ruling over a coalition that's very it's racked by infighting and bickering. I mean, he has 3 parties, which is in his coalition. There's the Social Democrats, the Greens, and the FDP. And they don't really see eye to eye on a lot of issues. And so a lot of these fights are coming out in the public. And that further undermines Scholz and the government's ability to operate and get things done. And that's a problem given where Germany is right now.
Is this something that might spread to the broader continent when you talk about what kind of precedent Germany might set in terms of this trend?
Yeah, well, as Germany gets, the risk is that as Germany's political fragmentation and it becomes less and less predictable in how it's going to act, and then that you have populism spreading anyways, across the continent. And but Germany, because of its position, obviously its role as the economic powerhouse and it's supposed to roll as a political leader, if it can't maintain that role, it risks undermining the EU itself. And the AfD's policies are definitely directed towards weakening the EU, weakening Brussels. And that's a risk, for the region. It's a risk for stability, like what happens with Ukraine. There's all these crises that Germany really needs to be playing a role on. And that as the political environment fragments, it gets more and more difficult for Germany to take a role here. And that has ripple effects, much farther.
Bloomberg's Chris Ryder joining us from Berlin. We thank you so much for breaking it all down. Of course, you can read the Bloomberg Big Take, which he helped write on Bloomberg.com, or simply search NI Big Take on your Bloomberg terminal. Very, very quickly, I want to talk about some of the movers that we are seeing. Of course, the 2 major corporate stories right here in Europe are Telecom Italia and Ryanair. 2 different stories. Telecom Italia paring back. It's almost 5% gain, now down 3.5% as its deal with KKR under scrutiny. And as well, Ryanair higher by 6% after its first ever dividend of about 400 million euros, something that Ryanair investors really seem to be loving. More ahead. Stick with us. This is Bloomberg.